All right, so I want to do a quick video for you on mortgage rates, inflation, and how this is going to affect us over the next couple months here. So we know that inflation is just too many dollars chasing too few goods, and purchase power goes down, right? We've all probably seen that in our personal checkbooks and grocery bill. So the big point here, inflation is the biggest driver behind mortgage rates. When you hear the Fed hike, the Fed funds rate, they're really affecting the overnight lending rate between banks. It's not affecting longer term rates like mortgages. The biggest driver is inflation. And frankly, the Fed is hiking their rates to try and bring inflation down, right? So as we look at this chart here, 30-year fixed rate mortgage is on the top. The inflation is on the bottom. The core consumer price index is really just inflation. And we see that typically the charts follow each other, right? Except for after this recession, this line is a recession through 2020, followed by this QE period, this quantitative easing. So what's happening here? Well, we're in a recession. The Fed says, hey, we're gonna buy mortgage-backed securities to keep access to money easier. What that means is we're gonna keep mortgage rates lower artificially because we're buying a lot of mortgage-backed securities so that we can help boost the economy out of this recession we're in. And that's what the QE is they're just buying mortgage-backed securities, artificially keeping those rates lower. Now what happens is right here, they were seeing all of these, the inflation, the CPI start to increase, and you heard them say it's transitory, not here to stay. Eventually they found out, hey, yeah, it is here to stay. And they stopped this QE, this quantitative easing, and the markets did what they wanted to do, and rates went up as they should have been all along, frankly. Not to say anybody likes it, right? I sure don't. So what this means, the bigger question is, when will inflation peak? So if you look at how this consumer price index is calculated, you see that it's a rolling 12-month average. So every month we'll get the prior month's data, and that will replace last year's data. So we see this year, June, July, August, and September, those have been our current year's data. And it's been dropping off the old numbers. And currently we're at 6.6. So if you add up all these past 12 months, you see that we're at 6.6. I need to update this. We have received October's data already. If you remember, on November 10th, we got October's data, and it was lower than this 0.6, and it was actually lower than expectations. So it dropped pretty considerably, and that was good for the bonds market and good for mortgage rates. We had one of the best days in 30 years, or let me see, at least the past decade. And so why this matters is the Fed hikes. Like I said, they're trying to reduce inflation by doing that. Well, those hikes are starting to take hold, and it's easier for us to get these lower readings that are then going to continue replacing these higher readings up here, bringing inflation numbers down and bringing rates down. This is super important, and we see that these higher readings go through mid next year. So I'm looking at this saying, okay, we're going to see rates start to come down, and what's going to happen when rates go back into the 5s or even the low 6s? Well, there's buyers out there. We're still in a low inventory market, so that's going to flood the market again, and we're going to be right back into multiples. Let me know what you think, because I'm really curious to see how you think the market's going to play out this winter and coming spring. But there's one more thing I want to point out. I think that mortgage rates are going to drop faster than expected, and there's more data on why. So on this chart, we're looking at the 30-year fixed rate mortgage on the top, and underneath it, the 10-year treasury. Typically, 30-year fixed rate mortgages are about 2% higher than whatever the 10-year treasury is. And as we look back here, we see that time and time again, it's about 2%. So right here, we see the 10-year treasury is at about 4%, go 2% higher. Hey, that's where rates were, about 6%. Today, that's not what we see. We see we're at roughly 4. It's gone down since this chart. But then rates are at 7. We're at 3% higher. That's not normal. So what I what I'm trying to say is that when we see those inflation numbers start to come down more, we're going to see this start to go back closer to normal, which means rates will drop quicker than expected. And if you're wondering, why are we at 3% now versus 2%? It all goes into servicing a loan. There's value in servicing it for a long period of time, but the banks and smart money know that rates are higher than they should be. They're not going to get their servicing value over many, many years because people are going to refinance when rates come down. So this is really just saying, hey, a lot of smart money out there also thinks rates are going to come down. So let me know what you think. I hope this helped, and I'll talk to you soon.